This mini-lecture is the first of 3 that deal with the management and accompanying financial statement analysis of working capital and of the operating cash cycle. In this lecture, we define and discuss what working capital is and how to observe its components on the balance sheet. Let's think about what the working capital cycle is, and this is the biggest version of the working capital cycle that we get. And this is where a business actually manufactures its own product before it then sells it. Now, shorter versions will be businesses that purchase a completed product or are not selling a product at all, but are actually selling a service to customers. So this is the longest way around the cycle. We conceptualize it by thinking about, over to the left here, we're actually buying materials from our suppliers. And we need to think about this cycle in terms of what is our little dollar doing. It's all about getting the dollars around the cycle so that they can then be used again. The more times we can get the dollar around that cycle and reuse it, the fewer dollars we actually have to have invested in the cycle. So there's an efficiency issue involved here as well. We'll talk about that when we look at the ratios and how we measure it. So here's our raw materials. We haven't made a product yet. Somewhere along the way we have to pay our suppliers. So there's cash going out at that point where we pay. We take the raw materials and it goes into work in progress. We add labour costs and overhead costs to that manufacturing process, and eventually we get some finished goods inventory, which at that point are ready to be sold. Now, it doesn't happen that quickly, usually. We may have to put it in a warehouse or send it somewhere, and it may be a few days or perhaps even a few weeks before it gets to be sold. So notice we've sent cash out to pay our creditors, but at this stage we haven't got any cash in yet. Okay, so we've got finished goods inventory. Now think of this as a pipeline. The finished goods have to be sold, and we sell them to our customers, and then we're going to collect the cash from our customers. And so think of it as a pipeline, as I said. The finished goods are at the top of the pipeline. They're pushing down through the pipeline. They'll be sold. When our customers pay us, then we'll get that little dollar back, and then that dollar can go to work again and work its way around the cycle again. So from finished goods inventory being sold to our customers, if we give our customers trade credit, which we often do, then perhaps in 10 days or 30 days, depending on what those credit terms are, they will pay us. We'll collect the cash from those customers, and round we go, and the process starts all over again. Now that's our working capital cycle, and it's also, of course, the cash cycle, because the cash has to travel all the way around that cycle before it can be used again. Okay, so about this working capital management process. The idea here is to have as little cash invested in the working capital cycle as you can, consistent with managing risk. And the biggest risk, of course, is that you run out of money. And also managing the level of service that we want to have for our customers. Okay, so working capital management is always planned very carefully. And when we do that, we balance the costs and the benefits so that we get the optimum solution to what we want in our particular business. What we want in our business might be quite different from what another business or another industry does with its working capital. So we should never try and compare our working capital management with the working capital management of different businesses. It's interesting to compare them with other businesses in the same industry, but don't get involved with trying to compare it with businesses which are in different industries. So the benefits we get from having inventory on hand will be that we can service the sales demands of our customers, but the costs that we get from having inventory on hand will be that we have to have the investment in that inventory, and we have to manage the inventory and keep records and make sure it doesn't become obsolete. And so there are always trade-offs. What we look for is the optimum balance for our particular business, consistent with the risks we're prepared to take and the level of service that we want to provide to our customers. Some terminology here first. Working capital, the funds in current assets. Now, the main current assets and the ones we're going to look at will be accounts receivable and inventory, and cash, of course, the end game. The term net working capital is referring to the total of current assets less the total of current liabilities. Now, remember what it is that defines an asset or a liability as being current. We find these current assets and current liabilities on our balance sheet, and they're current assets because we intend to sell them and turn them into cash in the next 12 months. And they're current liabilities because those are obligations that we know we are going to have to pay out in the next 12 months. So the 12-month split between current and non-current is the delineator here. So again, working capital, the current assets that will become cash in the next 12 months. Net working capital, current assets minus current liabilities. To be a current liability, you have to be planning to pay it out within the next 12 months. Now, that's the list of what you will typically see on a balance sheet under current assets and current liabilities. What we're aiming for here with managing net working capital is three generic things. The first and most important is that we must maintain enough cash, that's enough liquidity, in order to be able to be certain that we can pay our bills as they fall due. So maintaining sufficient liquidity in our system so that we know that we can pay our creditors, which is the main one here, when they are due to be paid. Now, consistent with that goal, we know that we also must not have too much liquidity in the system, because if we did, that would be lazy money sitting around and not working. And we can see that because we know that there is a required rate of return on all of the assets that investors require. And so if we have too much cash invested in our working capital and it's not working hard enough, then that will reduce the rate of return on our assets, and that in turn will mean that our investors are being shortchanged. They're getting a return which is lower than optimum. Now, we balance that against another cost, which is the cost and the risk of having short-term funding. Short-term funding, we know, has to be repaid in the next 12 months. And so if we haven't got the cash on hand to repay, then we're in trouble, because if we can't pay our bills when they fall due, we are insolvent, and if we're insolvent, we have to close down our business. So all the time we're balancing these competing demands, wanting to keep enough cash in the system to be able to meet all of our bills as they fall due, and to be able to do that without being squeezed and being particularly uncomfortable and wondering whether we're going to be able to pay it or not, but also knowing that we don't have too much lazy assets sitting around not working.